Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. The purpose of this particular video is a response to a couple of comments I've got in a previous article where I talked about the essence of valuation, where people were challenging the idea of a 15 PE ratio as being what I would call common or normal fair value reference line for most, but not all companies. And one of the things that I think confuses people is they automatically believe that a higher growth rate would command a higher fair valuation PE ratio. So what I want to do with this video is I want to basically illustrate how FastGraphs, first of all, applies these fair valuation reference lines. And by that, I'm referring to the orange lines on a FastGraph. And you can look into the color-coded section of the FastGraph here and see two things. The formula that we use, this stands for Graham-Dodd formula when it says GDF, and then the multiple or the PE ratio that we actually apply to the orange line. So in this example where I'm looking at Southern Company since 2002 with earnings growth of 3.56%, I've got a fair value PE reference line of 15. Now, this is the real world. This is historical reality going back to 2002. So now when I add monthly closing stock prices to that graph, we see that this becomes a very credible, very relevant, and very prudent fair valuation reference for investing in this utility stock if I chose to do that. The point being is that, 15 PE ratios plus or minus a little bit, are the best times, or I would say sound times, to be investing in this utility. You get pretty much all of the growth plus the dividend income. Of course, if you can buy a utility like this at a very discounted PE, like here we have April of 09, you could have bought it at a 12 PE, you could actually accelerate your rates of return above and beyond the growth rate. But I also want to point something out. I'm going to lengthen the time frame here and go to an all graph and notice that the growth rate has changed. We're still utilizing the Graham-Dodd formula, but now because the growth rate is actually 2.49% or 2.5% below the 3, we actually end up drawing a fair valuation reference of 13.48, or we'll round it off to 13.5 in the pop-up. So what I've got here now is a fair valuation reference, but when you look at this, you clearly see that it is not as profound, or it doesn't work as well. It's not that we're trying to fit a narrative here. We're trying to draw a valuation reference line on the graph that can help you make better investment decisions. That's why we have two valuation reference lines. The second one is the normal PE ratio, or the PE ratio that was most commonly applied for whatever time frame we're graphing. And in the case of Southern Company here, we're right back to that 15-ish PE ratio. It's never perfect. It's not meant to be precise. It's meant to be a relevant line. So now I've got a blue line on the graph that is a PE ratio of 15 rounded 0.7. Okay, 15.7. No matter where I touch the blue line, or no matter where the stock touches the blue line, that's approximately a 15.7 PE ratio. But once again, I utilize this information to try to make a decision of if I was going to invest in Southern Company, when would be a good time to invest in the company. And by utilizing this tool and even running these different time frames, I can conclude that a 15 PE ratio is probably an attractive time or a sound time to be investing in the company. Now, that simply means I'm going to get all of the benefit of the business plus the dividend income by doing that. But now let's move to a second example. Let's move to a faster growing stock like American Express here, the financial company American Express. And now I want you to notice that we've got earnings growth of 12.27%, significantly faster than the 2 or 3% growth rates we saw with Southern Company. But once again, we're still applying a 15 PE ratio. Now, we're using a different formula here. We're using an extrapolation between the Graham-Dodd formula and Peter Lynch's famous formula, P equals growth rate, which is what PEG signifies. And GDF, of course, is the Graham-Dodd formula. But the key is not that we're not trying to fit a narrative. The key is, does this have any value under real-world application? If I look at American Express going back to 2002, once again, a 15 PE ratio gives me a very rational, prudent, sound level that I can invest in American Express and make money. And of course, when I get opportunities to buy it at lower PE ratios, I can do a whole lot better. These are optimum times, or you might say opportunistic times, to invest in the company. All right, so now I've got two formulas, the Graham-Dodd formula, and I've got the Graham-Dodd P equals growth rate, or the second extrapolated formula. So let's move on here now, and let's move on to a little faster growing stock. And so far we've seen the 15 PE ratio applied pretty commonly, but now we're looking at AutoZone where we have a growth rate of 18.5%. So now the fair valuation reference line that FastGraphs will automatically apply is 18.5, or PE equal to the growth rate. That's the P equal G line that I talked about earlier. Now again, it's a valuation reference, which means you must think with this tool and you must analyze what you're looking at. Ironically, or interestingly, whichever way you want to look at it, we also have a normal PE ratio of 15 again, 15.19, but that's 15-ish drawn on this graph. And what you once again see, even at an 18% growth rate, the market, I can logically state that Mr. Market says that I'm probably safer to buy this stock at a 15 PE. On the other hand, if I buy it at a 17 or 18 PE, like I could have back here in December of 2003, I could have bought it at a 17 PE and held it through yesterday's close, I would have made 16.7%. So it's not that by paying higher than a 15 PE I lose money. It simply means that, I could have done better if I'd have waited and bought the stock a few months later at an 11 PE. My rate of return would go up to almost 20%. So valuation matters, and it matters a lot. But the idea is, you're trying to determine what is a PE ratio that the FastGraph research tool would apply. Now I'm going to move on to another example here. We're going to look at Ameritrade, and we're going to see another valuation reference calculation that is applied automatically by FastGraphs. And here we're seeing an earnings growth rate of 20.3%, and therefore we're applying a P equals growth rate fair value reference of 20.32. Now this is a lot lumpier because we've got some, flat growth, and we've got this big explosion in growth. But once again, by looking at a 20 PE, I can look at this tool and say, hey, what valuation multiples would make the most sense to pay or to utilize when I'm trying to invest in TD Ameritrade? And obviously something at 20 times earnings or below would be optimum. But once again, I get this 15 PE rearing its ugly head occasionally. Now, if I shorten this time frame a little bit like I did with the other graphs, I want you to notice that's too much. Let me go to 19 years. I don't have a calculation. I had a crazy number. Now I got 20.42%. So now I'm applying a PE of 20.42. P equals growth rate. But once again, I use this to evaluate whether or not this investment makes sense at that level. Now, ironically, the normal PE and the P equals growth rate are almost identical. If you look very closely, you can see traces of the blue line on the graph here. So it's, looking at historically for TD Ameritrade, how I use this is, a 20 PE is about what you got to pay to buy that company. Now let's move on to another stock, a much faster growing company, and one that was talked about in the comment thread that I was referencing earlier. Let's look at NVIDIA and look at how the FastGraph applies a PE ratio to this company. Now here we got earnings growth of 33%. So once again, we used the PE of 33.2. So the orange line, just to be clear, is a PE ratio of 33.2. Anywhere I point to the orange line on this graph, it's a PE of 33.2. We don't automatically just apply a 15 PE. But if I'm looking at the real world here and evaluating and thinking about what I should be paying to buy NVIDIA, it makes pretty clear sense to me that a 33 PE ratio works. I could buy the stock at a 33 PE ratio, and that PE ratio is going to hold up in the real world. Now, I have a rather long period of 3 or 4 years here where the PE got down to that 15, 16 or lower PE ratio that I've often talked about. But then once we got a surge in growth, we end up getting a much higher PE. But watch if I really shorten the time frame again. Now I'm looking at earnings growth of 38.2%, and we're drawing a PE of 38.2 with the orange line. But here we see the valuation reference of 28. So I'm using this information to make decisions with. I'm not saying absolute fair value is 38 times earnings, or even absolute fair value is 28 times earnings. I'm looking at this graph and saying, hey, these are valuations that you could pay. But here's the key to this kind of growth. When you're looking at this kind of growth, you have to understand the power. in other words, you're paying $38 to buy $1 worth of the company's earnings. So just kind of playing with the numbers a little bit, if I look at 2015 earnings of this company, it was $1.12. But look what's happened by 2019. It's earning $6.63. We'll call that a six-fold increase in earnings in just 4 or 5 short years, which is this very powerful level of cash flow, which basically obviously allows you to see a significantly higher valuation reference on a company that's growing this fast. And then last but not least, if we go and look at a company like Facebook, you're going to see another company that has a very high growth rate of, in this case, over 30%. If I look at the entire history of Facebook, going back to the all graph, we see that the earnings have grown at 36.3% on average. And therefore, we apply a fair value PE ratio of 36.3. But once again, as I'm looking at this graph, I can see that that makes a sensible valuation. But when you're looking at real high growth stocks like this, like the comment that one gentleman made in the last article I did was saying, it doesn't work for these high software companies and, companies like Netflix and Facebook and Salesforce and so on. He was right, but he was assuming that fast graphs only apply to 15 PE. It doesn't. It tries to give you a valuation reference that makes economic sense. Now, what's really amazing about these very fast-growing stocks, right here, I could have paid a PE of 66. We'll call that almost twice the company's growth rate. But again, because of the power of compounding, look at this earnings growth. It went from 88 cents, or, we paid 66 times 88 cents to buy the stock. If you want, I'm playing with the numbers a little bit, obviously. But by 2018, that dollar's worth of earnings grew to $7 of earnings. It went sevenfold in just a matter of 4 or 5 short years. And so even though you paid such a high valuation for Facebook, if you held it through yesterday's close, which now it's only trading at a 27 PE, you'd have still made 20% a year on your money. So this is the power of compounding that I'll be talking about in my next article. So the bottom line is, what FastGraphs does is it applies fair valuation references that are driven by the company's growth rate, and it's applying a historical valuation reference to the graph, and you're going to see this PE 15 show up. Here's 10% growth on General Dynamics, which I talked about earlier. But I also want to caution you about something. When you're looking at these stocks and you're looking at what their potential growth is, keep in mind this is just giving you historical evidence of what fair valuation has been based on historical growth. When you're making future decisions, you need to be making those decisions based on what the expected future growth might be. So if you look at a company like Facebook, for example, and look at what the future growth would be, if you're only looking at a forecast of 11%, now we're back down to that normal fair value PE of 15. Might make sense. After all, this is a $500 billion company now, and it's expected to have the growth rate almost, 2/3 slower than it has historically been. And, now the question is, as an investor, you got to ask if this is practical or not. If it's growing at 30% a year like it has, then, this would still be a fairly valued stock. But if only going to grow at 10 or 11%, you better make that adjustment that a new PE paradigm might exist for this company going forward. And that would be true of any company you're looking at. Let's go ahead and close this graph by looking at Salesforce.com, which was one of the ones that we, again, brought up into the thing. Now, it's expected to grow at 17% going forward. If I look at its historical growth, it has averaged over 56%. And what FastGraphs did, because its P equals growth rate, we applied a 56.7 or rounded PE ratio to this graph, and even then this company traded at much higher valuations. And even had you paid 100 times earnings, you would have still made money buying this company in March of 2011 and holding it through yesterday. You'd have made almost 19% a year. And that's again because earnings went from 30 cents a share to well over $1 a share, or $1.35 a share in this short period of time. So when you're dealing with very, very fast growth rates, you apply a higher PE ratio. But I also want you to notice something. As you start shortening the time frame here, you'll see the growth rate's been cut in half almost to 30%. 30%. Now we're down to 29% growth. I shorten the time frame again. We're back up to 34% growth. But if I go forward, we're looking at 17% growth by a consensus of a bunch of analysts, over 40 analysts forecasting growth. The long-term trend line growth, I might add, is still expected to be 25. So if the P equals growth rate formula comes to reality, then you've got a positive rate of return on this company, but a rather mooted total rate of return over the next 3 to 5 years, and you've got a potential for a pretty big drawdown in the short run. So the idea is this is a tool to think with. It's designed to help you evaluate what would be a sensible valuation to pay for a company by looking at past, present, and ultimately future potential growth rates. Now, you can also apply this same type of information to several different metrics. The tool was designed to do that. For example, if I'm looking at Amazon, maybe the 800-pound gorilla in the marketplace right now, PE ratios don't really have any meaning. If I look at Amazon, looking at it from a point of view of operating cash flow, I start to get some really interesting fair valuation metrics. Here, we're applying a priced operating cash flow of 33.7 and a normal priced earning cash flow of about 25. And again, by looking at this, I can, I think logically say that if I want to own Amazon, if I can buy it at around 24, 25, 23 times cash flow, it's a pretty good buy, which is where it sits today. I can also look at it from a softer form of cash flow like EBITDA and say, hey, I need to be buying this at about 40 times EBITDA. Let me shorten this so I get some good numbers here. At maybe 38 times EBITDA, and the stock has traded at 38 times EBITDA. So we're not fitting a narrative here. What we're doing is we're applying common sense valuation formulas that draw a fair valuation reference line in a graph that can help you make sound decisions. But again, when I'm looking at forecasting in the case of Amazon, estimates are for EBITDA growth to still remain at 34%, which would suggest that this high-risk, high-growth stock, even though it's AA rated, AA minus rated, would be a very attractive buy here based on EBITDA. And again, I could go back to operating cash flow and do a similar analysis. And what I would do is I'd go through all of these, and we're looking at operating cash flow growth very similar to what we saw with EBITDA, and even the shorter term estimates are looking at 27% growth, which would suggest that you can still buy Amazon attractively. So we're not fitting a narrative here. What we're doing is we're trying to apply valuation reference lines, or we're using widely accepted formulas to apply valuation reference line to these companies that make sense and that help you make a better investment decision. To my view of thinking, investors who don't have the advantage of what fast graphs offer are being blind. If you're investing in stocks, a subscription to FastGraph might be very well worth the money. So I did want to try to clarify how FastGraphs applies their valuation reference lines. I hope you found this useful, and if you enjoyed this video, then please hit the subscribe button below here and take a look at FastGraphs and see how it can help you make better and quicker long-term investment decisions in common stocks. Thanks for watching.